Okay. So far in the previous two videos, we have seen methods to calculate national income. Then we have seen different forms of national income. So we need to see what were the changes that has happened post 2015. Before understanding this, we will try to understand the concept of factor prices and market prices. So whenever you buy any product from the market, we call it as a kind of market price. In the market price, let's say you have purchased some chocolate, dairy milk. Okay, the taxes are included in it, right? You don't pay additional taxes later on. So whatever the taxes, the indirect taxes that are there, it is already there on the product. Okay, let's say farmer is buying some fertilizer product. So whatever the final market price the farmer pay, it will be inclusion of taxes and deduction of the subsidies, right? So farmer, let's assume that he's paying the market price of 100 rupees. Actual product, let's assume it is 200 rupees. Government is giving, just hypothetically, 120 rupees of the subsidy and 20 rupees of the taxes. So the product becomes 200 minus 120 plus 200, it should be minus 120 plus 20. So you will get 100 rupees. So market price is equal to factor prices plus net taxes, which include taxes minus the subsidy. So this is the factor prices. Previously, we used to use the factor prices before 2015. Later on, market prices are being used. When I have mentioned that we use value added method, I told you GDP is nothing but the summation of gross value added at all the sectors. But how do you arrive at the gross value addition? I have told you it is nothing but the final value minus initial value, right? So here we are actually calculating the market price. However, post 2015, there is little more additional changes in this concept of the market price. It is not as simple as this. Government has added different layers by giving the definition to the market prices. This is also the international standard. Now, what is that thing that has added by the government? So, like I've said, we calculate GDP at the market prices. Now, what is the formula for this? GDP at the market prices can be arrived by GDP at basic prices plus product tax minus product subsidy. Now, what is this GDP at the basic prices? It is GVA at factor cost plus production tax minus production subsidy. Now, you guys might be thinking, what is this product tax and what is this product subsidy and what is this production tax and production subsidy? Okay, this thing can be pictographically represented in this format. Okay, let's say at the factory, you have produced something. Okay, we can consider here, you can call it as a kind of GV at factor cost. Here, finally, the product, when it reaches to us, then we can call it as a GDP at the market prices. Somewhere in between here, GDP of basic prices we can calculate. So this is the factor cost, nothing but the factory prices, which is not inclusive of any taxes and subsidies. So certain item is produced there, some fertilizer is being produced at the company. Now, during the production stage, when it is produced on a whole unit at the production stage, there can be some kind of taxes. It is not on the individual product. It is being considered at the whole level. So there you will call it as a kind of production tax. What are the examples of these production taxes? Maybe your land revenue, stamp duty. So all these things comes under the production taxes, where you are imposing tax not on the individual item, but on the whole system itself at the production level. So to the price of the production at the factory level, when you add the production tax and when you deduct the subsidy value, then you will arrive at the GDP at the basic prices. Now we added to this, you are adding to the individual taxes and individual subsidy. Let's say individual bag. Now many bags have been produced from this factory. Whether you produce 1 bag of fertilizer or 10 bags of fertilizer or 100 bags of the fertilizer, it does not matter. The production tax remains same on this entire factory or entire land. Right. Now, from this, let's say 100 bags are produced. Now, independently, each bag is being sold. Now, on these independent items, there is a tax that is called the product tax. And it can be independent subsidy also on this independent item. That is called the product subsidy. So, this is called the product tax minus product subsidy. So, once you arrive at the GDP at basic prices, then when you add this product tax and subtract the product subsidy, then you will arrive at the GDP at the market price. That is what written here. So GDP at the market prices will be arrived by adding product tax and subtracting the product subsidy from the GDP at the basic price. That is at somewhere lying at the intermediate level. Now, how this GDP basic prices can be arrived? When you add to the factory cost whatever the production tax that is there on the whole items, and whenever you deduct the subsidy that is giving on complete area or on the whole items, then we'll consider as a GDP at the basic prices. So then this is what the difference that they have made. Before 2015, they have used simply the same formula which we have said of net indirect taxes. But they have added this basic prices concept post 2015. And this was exactly the question that was asked in 2021 or 2022 mains. Now, what were the changes that were made post 2015? So there we need to write the base year was changed to the 2011. Second thing, then you will write GDP at the market prices were being used instead of GDP at the factor cost. Okay, so you will explain the same formula which I have mentioned here. And also then value addition method. Value addition method is used to calculate GVA basic prices for sectors like primary sector and registered manufacturing units. Registered manufacturing units. While income method is used for unregistered firms. Unregistered firms plus service sector. Why is this so? Our